Hello, dear viewers. In this episode, I'd like to talk about the confrontation between Donald Trump and Jerome Powell, the chair of the Federal Reserve. Why am I bringing up this dispute right now? Because it's gaining new momentum. Specifically, media outlets have started publishing headlines naming two potential candidates to replace Jerome Powell. So, I want to shed some light on what this dispute is really about, why Trump dislikes Powell so much, even though Powell was his own appointee. I'll remind you that Trump actually pushed Powell into this position back in 2018. We'll also look at what effects either a replacement or Trump pressuring Powell to cut interest rates might have on the U.S. economy and financial markets in general. So, where does this dispute come from? From the very beginning of his trade saga, Trump has been pushing the idea that America needs cheap money. This is a logical argument, since theoretically, to stimulate domestic production, you need cheap money, that is, lower interest rates. But what Trump didn't take into account is that no one really intends to rebuild industry like it exists now in Taiwan, China, or elsewhere in America, because that would make goods simply uncompetitive. They'd be way too expensive. And building up such industry would take many years and far more investment than just lowering interest rates could provide. Despite this, you've probably seen tons of posts on Trump's Twitter and in the media calling Powell the slowest Fed chair and demanding he step down. This is basically Trump's main position right now. Powell should resign from his post and make way for someone new who will follow Trump's orders, no matter how populist, without any pushback. Meanwhile, Jerome Powell is mainly relying on U.S. macroeconomic data, which shows the labor market is strong and robust. There's no need to stimulate the economy from that side. On the other hand, inflation indicators remain relatively high. The Consumer Price Index (CPI), which the Fed closely monitors, shows inflation is still slightly above target. So, if we cut interest rates now, we risk triggering another inflation surge. That's something we don't want and can't afford. However, just a few weeks ago, new data hinted this trend might be changing. According to Q2 2025 GDP figures, the U.S. economy contracted by 0.5%. This is a clear sign that something in the American economy is slowing down. This is further supported by data on non-farm payrolls, which showed that in June, the U.S. economy lost about 30,000 jobs. These two fundamental indicators that the Fed uses to decide on interest rates suggest the economy isn't doing so well. It seems Powell has outgrown the phase he was in when he took office in 2018. Since then, he has gradually lowered rates from 2.25% to 1.75%, essentially fulfilling Trump's demand to replace Janet Yellen and cut rates. Now Powell is resisting, but it looks like this resistance is nearing its end. So you might ask, if Powell cuts rates now, will Trump back off and let him stay? Actually, no. For two reasons. First, macroeconomic data will likely worsen as the effects of tariffs ramp up. You've probably heard that Trump is again talking about tariffs, imposing additional 20 to 30% duties, and even suggesting 50% on copper. This saga continues, and its impact on the economy remains to be seen, since these are just the early echoes of the April tariffs. All subsequent tariffs and maneuvers will continue to affect the economy. How the Fed will respond, whether proactively or reactively to actual changes in data, we'll see. But I believe the market's expectation of a 0.5% rate cut in 2025 will hold. So, this year, we probably won't see rates drop below 4%. Although things could change, for example, if the Fed chair changes. Speaking of which, media have started naming potential replacements for Powell. There are two Republicans, Kevin Hassett and Christopher Waller. Their party affiliation doesn't really matter since Powell is also a Republican. What matters more is their financial background. Both have solid experience working in major financial institutions, both private and public. Powell's experience was mostly in government institutions. Whether that's good or bad, I'm not here to judge, but it's a fact. Another fact is that media are already casting doubt on the objectivity of whoever becomes the new Fed chair, whether Hassett or Waller. It's quite likely they will, like Powell, initially follow Trump's wishes. How this will affect the economy, we'll discuss later when we look at expectations for this year. I think Powell will likely finish his term, which ends in 2026. He started in 2018, so this is effectively his second four-year term as Fed chair. What could a rate cut bring to the U.S.? Let's start with the positives. The main effect, and one reason Trump pushes so hard for rate cuts, is the impact on the bond market. A key part of Trump's financial strategy as president is to reduce the cost of servicing the U.S. national debt. With such a huge debt, interest payments have become enormous, forcing cuts in spending or attempts to keep the budget balanced to avoid growing deficits, and borrowing more to cover past interest. The bond market's reaction will be clear when the Treasury issues bonds at lower rates, and we see how willing the market is to accept those lower yields. Earlier this year, this was a big problem. Either rates had to rise, or auctions failed because no one wanted to buy bonds at low rates given America's debt issues. Another positive from rate cuts could be growth in riskier assets and the market overall. Moderate inflation expectations can benefit the market, unlike the runaway inflation of 2022. If inflation numbers come in slightly above the Fed's 2% target, markets will likely rise as people move their savings into assets to protect against inflation. So markets should grow if there's a moderate rate cut, like the 0.5% currently priced in. Riskier sectors would especially benefit. Shares of quantum computing companies, which soared in late 2024 and early 2025, cryptocurrencies, especially altcoins and shitcoins, and Bitcoin itself would likely rise with a rate cut, as money flows into crypto markets. However, we can't ignore potential downsides, especially with a new wave of tariffs looming. How these tariffs will affect the economy, whether they slow it more or less than current tariffs, is uncertain. There's a saying that Trump always chickens out. But will he this time? Will he back down on tariffs or not? What will happen? Major decisions aren't being made in this environment. This is one reason I think we won't see significant rate cuts this year, probably no more than 0.5%. At least that's if Powell stays. Trump could push him out, saying, "Get out!" and ramp up media pressure to force him to resign, just like Janet Yellen was pushed out. Then a Trump appointee might aggressively cut rates. But under the Fed's current cautious strategy, I think we'll see a gradual stabilization, a steady baseline, to see how the economy digests tariffs and all this turmoil, before slowly moving to further rate cuts, maybe down to 3.5% or even 3% by 2026. We'll see. Hang in there. All the best to everyone. Goodbye.